Hi, welcome to 4.04, the Stock Market 1. This is the beginning of the lesson and slide 1. An investment in knowledge always pays the best interest. Benjamin Franklin. Almost everybody has to work for a living. After all, that is how we make money. But money itself can be put to work making money. When people invest their money, they hope that it performs well at that work and brings them back even more money. Investments are made by purchasing an asset. If that asset grows more valuable, the investor makes a profit. There are a lot of ways to invest. Buying a house, for instance, or becoming a partner in a business. One of the most popular ways to invest is by purchasing shares of a company in the stock market. The U.S. stock market is the biggest stock market in the world. All the most powerful investors buy and sell stocks there, and so do many regular investors, even young people. Learning about the stock market is an investment in self. Knowledge of how this lucrative market works and what makes some investments pay off can help you make good investment choices in the future. What makes the stock market so popular with investors? Although there are many safer ways to invest, people buy stocks because they want their money to work harder. With an FDIC-insured savings account, an investor knows that his or her money is safe. By purchasing a home or other real estate, an investor is secure in the knowledge that the investment is secured by actual property. But the stock market is not so safe. An investor can lose everything. Still, in the long run, stocks have the potential to give back a higher return than many other investments. A general rule of investing says that the more risks one takes, the greater the opportunity for high returns, as well as significant losses. To learn more about what makes the stock market so popular and risky, begin by understanding exactly what a stock is. You will see what it means to be a stockholder. You will also examine the different kinds of stocks and see which companies trade stocks and why. Your money at work. Stocks are a popular way that investors put their money to work making more money. In fact, for most investors, stocks are the tool of choice for growing wealth. To do so, stock investors follow some simple rules. First, an investor needs access to surplus cash that can be committed for a long time, possibly many years. Stock market investors must be patient. Second, investors must have a variety of stocks to spread out the risk. Third, investors must know how to sit tight and ride out the up and down swings of the market. Of course, if a stock is really falling fast, one also has to know when to get out. Fourth, and most important, smart investors reinvest what they earn. It is often tempting to cash in on one's earnings, but if you keep reinvesting, that is when your money will really start to grow. The history of stocks. Stocks are shares of ownership in a company. Owning a share entitles you to a claim on a portion of the company's assets and profits. Before the development of modern businesses, stocks were just supplies of commodities, such as domesticated animals and grain. Stocks emerged after people began building large communities and began to accumulate surplus. After trading money, money came into use, which made it easier for people to acquire goods. Likewise, people started using tokens to symbolize ownership of quantity of goods, which facilitated trading. These tokens could be called the world's first stock certificates. Archaeologists found that the people were using these clay tokens as long as 6,000 years ago. Over time, clay tokens became more elaborate and varied, marked with symbols representing specific commodities such as sheep, bread, cloth, and metals. Today, people still buy and sell stocks in real commodities such as livestock, gold, and oil. But people also trade financial stocks, which are shares of ownership in a business. Instead of clay tokens, stock certificates are used to show possession of shares of ownership. Those who invest in stocks put their money into someone else's business. In effect, stockholders put on the uniform or vest of someone who is part of that business. The word invest comes from the Latin word vestis, or clothes, and investire, which means to clothe in, cover, surround. If you have a lot of different stocks, you wear many vests. The history of stocks. The first stock certificate was issued in 1602 when Dutch traders formed the Dutch East India Company. The company issued shares of ownership in the company to the public. The shares sold rapidly and they could be traded, so any Dutch person could own one. The huge sum of money generated from the sale of shares allowed the Dutch East India Company to build a fleet of over 150 merchant ships. The ships sailed routes to China, Japan, India, the Persian Gulf, and Africa, bringing back spices and other exotic commodities such as tea and silk to the Netherlands. The Dutch East India Company became the richest and largest company in the world, dominating the spice trade. This proved how powerful a business could become by selling shares of ownership. The practice of issuing stock certificates has been around ever since. Why do companies issue stock? What motivates a company to share its profits with thousands of strangers? Business owners almost always sell shares of their company for one simple reason: to raise money. A company first starts selling its shares at its initial public offering, or an IPO. The motivation behind an IPO is to acquire money to grow and develop new products and new ways of getting consumers to buy them. Maybe the company wants to build new facilities or hire more workers or embark upon a new marketing strategy. If the owners cannot come up with the money on their own, they offer shares of the company to obtain it from investors. Selling shares in a business allows the company to raise money without going into debt. The stockholders' investments create a pool of money into which the company can dip at any time. But when companies issue shares, their stockholders become partial owners of the business, and the company needs to keep them happy. The company also has to make disclosures about its financial affairs, give up some decision-making power, and adhere to a long list of restrictions and regulations that govern the stock market. What is a stockholder? Someone who invests in the stock market becomes a stockholder, also called a shareholder. A stockholder has purchased a share of ownership in a business and so enjoys certain rights. Stockholders are entitled to a piece of the assets owned by the company. In fact, every shareholder owns a part of everything the company owns, even if it is just a tiny share. As the company's assets grow, so does the value of the shares. As partial owners of the company, stockholders are entitled to a share of any profits the company makes. The company might choose to return some of the profits to stockholders in the form of dividends. Instead of paying dividends, though, the company might reinvest its profits to achieve growth. If a company is growing, it needs capital, so profits are typically reinvested in projects to build the community. No dividends are paid out. If the company grows from its reinvestments, stockholders can get a capital gain or stock appreciation. That means the shares have increased beyond the original purchase price. Stockholders have a few other rights. They have the right to vote on issues of importance to the company, such as who gets to be on the board of directors. Stockholders also have the right to information about the company in quarterly and annual reports that inform them about their company's operations and financial situation. The flip side of being a stockholder. Before buying a stock, an investor must be totally clear on what it means to be a stockholder. It can be a complicated job, and it involves a lot more than just holding on to some pieces of paper. Stockholders are partial business owners, but their share of the pie may be extremely small, depending on how many outstanding shares exist. If a company issues 1,000 shares and an investor owns just one of them, she owns just 1 out of 1,000 of the company, or 1/1000th. A slice of the pie, in other words, might be just a crumb. Stockholders are not guaranteed any returns on their investment. If the company does not make a profit, investors do not make profits. If the company goes bankrupt, the company's creditors have priority and will be paid before stockholders. If there's anything left over, the stockholders get to divvy up the crumbs. Stockholders also do not get to tell the company what to do. Investors can vote for members of the board of directors, but they have very little say in business decisions. If an investor is unhappy with how the business is run, she can vote for a different board next time around or sell her shares. Finally, Stockholders are usually not entitled to special discounts or other benefits from the company. The flip side of being a stockholder. And go ahead and do the little activity of what a stockholder gets and test your knowledge that way. The next recording will continue with slide 12. As always, let me know if you have any questions, and I hope you have a great day.